Hi, I'm Chris Sabula and I'm here with Mark Armbruster. We're here today to discuss value investing and what could turn out to be a once in a lifetime opportunity for investors. Value investing is simply trying to buy stocks that are cheap relative to their intrinsic value. That might be buying great stocks at good stocks at good prices, or even mediocre stocks at great prices. The key part is to trying to pick up assets on the cheap. An example of this is Tesla versus Ford. Tesla is clearly a growth stock with accelerating sales and growing market share, whereas Ford, as a mature company that grows in line with its industry, is more of a value play. One way to measure this is by stock market capitalization. The total value of Ford shares in the stock market is about $19 billion. On the same basis, Tesla is worth 8 times as much at $152 billion. This is despite the fact that the 367,000 vehicles Tesla sold last year only amounted to 7% of the 5.5 million vehicles that Ford sold. So, which is the better company? You could argue that Tesla's dynamic vision for the future makes it a better company than a stodgy old manufacturer still tied to legacy technology. But more importantly for investors, which is the better stock? That depends on the price at which you buy and ultimately where you sell. From today's values, it may be that Tesla's stock is priced for perfection, and in order to continue to advance, the company must accomplish truly exceptional things, since the stock is already priced for success. On the other hand, Ford probably only needs to execute reasonably well for its stock to rise significantly. It certainly could be the case that Ford ends up being more rewarding for investors over time.
That's a great point. The goal of value investors is to buy a whole portfolio of companies like Ford that trade at attractive prices. It might sound counterintuitive to focus only on price rather than on finding great companies to own in your portfolio, but historically, the best returns have come from buying at the right price rather than buying the best companies. In fact, you can see from this graph that value investing over the very long term has resulted in significantly higher returns than growth investing. When the red line is rising, it means value stocks are outperforming growth stocks. And of course, value underperforms when the line is declining. So if you invested $1 in value and $1 in growth in the 1920s, the value portfolio would have grown to 10 times more than the growth portfolio by 2007.
The problem is that there have also been some painful periods for value investors that can stretch for many years, including the past 13 years when value has underperformed growth by about 50%. This has led many investors to question whether value is still a valid strategy, or whether the new economy has resulted in permanent changes to the behavior within the capital markets.
True, but even the recent downtrend in value is a fairly short period for the stock market. Investors often think of 3 to 5 years as the long term, but cycles in some parts of the market play out over periods of 10 years or more. It's tough to stay patient for that long, but that patience can be rewarded. This graph shows rolling 5-year average returns for value stocks versus growth stocks. Again, when the blue line is rising, value stocks are doing better than growth. What's interesting when you look at the data using longer-term averages is that these cycles are ultimately mean reverting. The trend always reverses course when it gets too far out of line. When value stocks have been very cheap, such as in 1991, 1999, and 2010, they have subsequently rebounded to their long-term average and usually beyond. We're at historically low levels of relative growth value performance today, indicating this may be an opportune time to buy in, despite the poor performance of the past decade.
Agreed. Market leadership does appear due for a change. Looking at performance by decade, the investment environment over the past 10 years has been similar to that of the 1990s. Large cap growth stocks, primarily technology companies, have dominated the performance of the stock market. In fact, today just 5 stocks account for over 20% of the value of the S&P 500, which is even more concentrated than during the dot-com boom. These stocks are all technology-focused companies such as Microsoft, Amazon, Apple, and Google. Just as the 1990s saw the dominance of large-cap growth stocks, the decade of the 2010s also saw significant gains in large-cap growth. Other market segments performed well, but all were significantly behind large-cap growth stocks.
There was a break in the middle, though. The 1990s and 2010s were great for large-cap growth investors, but the decade of the 2000s was atrocious. In fact, large-cap value stocks outperformed growth stocks by 6.5% annually on average that decade, and small-cap value outperformed small-cap growth by 9.7% annualized. That's a huge gap, and value stocks look even more attractive today than they did at the end of the dot-com boom.
Further evidence that value may be due for a long-term rebound is shown on this next graph.
Yeah, this page is a bit technical, but it shows how the stock market has performed over the various decades going back to the 1960s. The upper table shows the numbers, and you can see the pattern graphically at the bottom of the page. These returns are presented as excess returns that are shown net of the risk-free rate, which is how academics analyze stock market data. So the returns may be lower than what you would expect if you were looking at just gross returns. But the magnitude of the returns isn't that important. It's the pattern that's interesting. In the decade of the 1970s, the stock market's excess return was only 1.18% annualized, but the factor returns on the right-hand side of the table were generally quite high. Value, as one of the factors, returned 8.1% annualized in that decade. The opposite was true in the 1990s, when the overall stock market did very well. The market generated excess returns of almost 13%, but the factors performed poorly that period. The next decade, the 2000s, was opposite again, and the decade of the 2010s once again flip-flopped.
The point is that factor exposures, such as value, generally do well when overall stock market returns are anemic. Looking forward, and considering today's high valuations in the stock market, it seems likely that the overall stock market returns will be below average in the 2020s, which could set the stage for strong value returns to resume.
Returns from stock market bottoms have also favored value, and specifically small cap value. We expect the rebound from the COVID crisis to look similar. Looking out 1 year, 3 years, and 5 years from bear market bottoms has historically resulted in huge gains up to almost 90% for small cap value. This has been true on average since the 1920s and has even held true in more recent bear markets.
Perhaps the most intriguing argument for value stocks today is that their valuation is at the lowest level relative to growth stocks on record. This graph shows the price to book value ratio for growth stocks versus value stocks. Just as the PE or price to earnings ratio measures how cheap or expensive stocks are relative to their earnings, price to book shows how expensive a stock is relative to the value of its net assets. Academics use this measure since not all stocks have earnings, but they all have book value. Studies have shown that which metric you select isn't really that important, as price to earnings, price to book, and even price to sales and price to cash flow are all generally very highly correlated. So what we see here is that value stocks currently have historically low valuation ratios relative to growth stocks. It is striking that the disparity is even greater than the dot-com boom, when high growth tech stocks rose to extreme levels.
Yes, and while past performance for value versus growth doesn't look so hot over the past 10 years, historic returns, when value was at these sorts of discounts to growth, have been just phenomenal. You can't see it on this graph, but value stocks were also very cheap back in the 1950s. Warren Buffett was early in his career at that point, and his fund earned over 24% annualized from 1957 to 1969. The Dow Jones Industrial Average earned only 7.4% over the same period. Buffett got a lot of credit for being a skillful stock picker, but it turns out that simply buying the cheapest 10% of the stock market at that time would have delivered almost the same stellar result. That's not to take anything away from Buffett, as he was still smart enough to recognize a rare opportunity that eluded most others.
That same opportunity may be available today for those willing to invest in an asset class that looks pretty dismal in the recent past. But, as they say, past performance isn't indicative of future returns. We believe that is more true now than ever.
Right. While it can be tough to jump into an out-of-favor asset class, that is often when future returns are the best. And given, 1, the historic outperformance of value over longer periods, 2, the cyclicality and mean reversion of value returns, 3, the fact that the overall stock market may provide lower returns in the future, which is a time when factors such as value often outperform, 4, the fact that we're close to a bear market low and value stocks usually lead the market when rebounds occur, and 5, the fact that current low valuations for value stocks are at a historic disparity versus growth stocks. We think value stocks are certainly worth another look today.
As always, let us know if you have any questions or would like to discuss value investing in more detail. Thanks for joining us today.